Friends, now we will talk about an important aspect called cum interest and ex interest. Okay. What do these big words mean? You'll understand as we talk about it. Listen carefully. You are, say, A. Your friend is B. Your friend B already has investment in debentures of Tata Steel. Who has investment in debentures of Tata Steel right now? Your friend B has investment in debentures of Tata Steel. Right. Face value of the debenture is 100 rupees. Interest rate 12%. Interest is payable on 30th of June and 31st December of every year. Interest always will be paid on face value or par value. So, interest on every 100 rupees of debenture that your friend B is holding, that person will receive 6 rupees of interest on 30th of June and 6 rupees of interest on 31st of December of every year. This is the situation. On 1st January 2018, you purchase the debenture from your friend. You are A, you are purchasing the debenture from your friend B. Your friend quoted a price. I will sell this debenture to you at 101. Now, that person when he or she quoted the debenture at 101, that 101, does it include any interest portion or is it only principal portion? Listen carefully. When did that person receive the interest? If we are on 1st of January 2018, that person would have received interest on 31st of December 2017, because on 31st December there is a interest due date. So that interest of 6 rupees that person would have received. On 1st Jan 18, if you are asked to pay 101 rupees, in that there is no interest portion. That entire 101 is only principal portion. So basically, for debentures having face value of 100, you are asked to pay 101. So when we are recording that, is the cost 100 or 101? Our cost is 101 because that is what we are paying. So our cost is 101 in our books. Excellent. Imagine your friend asks you to pay just 100 rupees. Then what has happened? Face value of debenture is 100. What you are paying is also 100. So you are basically purchasing that at par value. Excellent. If you are paying 101 in that extra 1 rupee, is there any interest? No, there is no interest. Basically, your friend is selling it at a profit. Your friend is selling something worth 100 at 101. I am assuming for a moment that your friend would have bought it at 100 and your friend is selling it at 101. So your friend is making a profit of 1 rupee on the transaction. Now listen carefully, friends. You are purchasing the same debenture from your friend on not on 1st Jan, on 1st February 2018. Then say at same 101 rupees. If your friend is selling it at 101 rupees to you, is that person still making profit? No, that person is not making profit. Why? Actually, that person received last interest on 31st December 2017. For the month of January, interest is earned by your friend. Earned but not yet received. When will that friend receive interest? Had that person continued to hold the investment till 30th of June 2018, that person would have received 6 rupees of interest. But your friend is selling it away to you on 1st of February. So how much is the interest earned by your friend for 1 month? 1 rupee. How? 100 rupees is the face value, into 12% is the interest rate, into 1 month is over out of 12 months. So basically 1 rupee is the interest per month. So your friend earned an interest of 1 rupee and you are given a quotation. Hey, I am okay to sell this at 101 rupees. If 101 rupees is the price at which the deal happens, what does it mean? You paid 100 rupees towards principal and 1 rupee towards interest. So there is debenture, there is interest on debenture. Both are assets. I repeat, there is debenture that you are purchasing interest on debenture also. So there are two assets what you are basically buying. For the debenture purchase, you are paying 100 and for this interest on debenture, you are paying 1 rupee. So basically 101 rupees is what you are paying. If your friend bought it at 100, is your friend making any profit? No. The value at which your friend bought is 100 and the face value or principal value of the investment what you are purchasing is 100. So basically your friend is not making any money on you on the sale made to you. 100, that's all. 1 rupee, is that a profit that your friend is making? Don't call that as profit. That is an income that your friend earned. That friend would have received money on 30th of June. Instead of receiving on 30th of June, that person will receive it on 1st of February itself, and company Tata Steel is not paying to your friend, but you are paying to your friend that 1 rupee of interest. Friends, 101 rupees come interest. When I say it is cumulative of interest. Cumulative of interest means what? That price includes interest portion. It is not that it's the come interest, X interest is not something like a negotiation tool. Listen carefully. It is an expression. What do I mean by expression? Concentrate. If your friend quotes on 1st of February, hey, my price is 100 rupees X interest for this debenture. Okay, 100 rupees X interest. Because interest everybody knows how to calculate. So 100 into 12% into 1 by 12, so you know how to calculate that. So your friend quoted 100 rupees X interest. So that is excluding interest. Or your friend may quote, wait, I'll do the calculation, 100 into all this plus together, okay, 1 rupee interest I will add, 101 come interest, right? So 100 X interest and 101 come interest are comparable in this situation. So it is just a form of expression. How is that person expressing the quotation? So it could be come interest or X interest. Imagine the sale happened to you, means you purchased on 1st of March. Then if your friend should not make any profit, then what is the price at which your friend should sell to you? Think about it. 1 month of 1 rupee for January, 1 rupee for February, 2 rupees you add to 100, 102 rupees probably would be a come interest price if your friend should not make any profit on that sale to you. So friends, here when we pay money, some portion towards principal and some portion towards interest, in the initial recognition stage, the accounting standard says you will have to split these two assets and record them separately, because you have one asset called debenture, investment into debenture, second asset called interest, whatever you are entitled to receive now. It's not that you earned, somebody earned, you purchased that right from them. So I am repeating, you did not earn the interest for that period. Who earned? B earned interest for that period. You are purchasing the debenture from B. So basically you are purchasing along with the principal, you are purchasing the right to receive the debenture interest also. So friends, basically in such case, what should the journal entry be? Debenture, investment in debentures of so and so company, whatever, Tata Steel or any, whatever be the company, account debited with what value? What is the portion you are paying towards principal? So if you are paying 100 rupees towards principal, that much you will write. This is not the face value of debenture, mind you friends. If you are paying 101 only towards the principal, then you should write that at 101. You get that? Then interest income on debentures account debited, say 1 rupee, 2 rupees, whatever is the debenture interest, to cash or bank, 101, 102, whatever is the amount you are actually paying, you will write. So that is how you are supposed to write a journal entry at the time of initial recognition, considering the interest portion. Friends, the accounting standard says that if there is any interest portion, that interest portion should be separately recorded. But if there is any dividend portion, will we be sure as to what the amount of dividend is? I am talking about equity shares. Will we be sure about what the amount of dividend is? We will not be sure of that, because we don't know how much dividend will be declared. So we should not split at the time of initial recognition the dividend portion separately. We should talk about dividend only when it is received. So if it is something like, instead of it being a debenture, if it is something like equity share, then on the equity share, if there is an expectation that 2 rupees of dividend is expected to be earned, it may come, it may not come, and you have paid 1 or 2 rupees to your friend for purchasing the equity share. It is not debenture, say it is equity share. You paid 1 or 2 to your friend. Still you cannot say 2 rupees I expected I might receive dividend and I paid, I want to split that separately. No, you can't do that. You will have to treat the entire 1 or 2 as investment in equity share. Friends, you paid certain amount towards interest. When you actually get interest from the company, How should it be accounted for? That also can come in our mind. That also can be a question that can come to us, right? So standard makes it very simple. Listen, the last interest payment was on 31st of December. You purchased this investment in debenture on 1st of February. 1 month interest you paid, so 1 rupee you paid. You will receive 6 rupees on which date? You will receive 6 rupees on 30th June 2018, right? Why 6 rupees? Because whoever is holding the debenture at the end of the period, so that is the person who is going to get the entire 6 months interest. So you are the one who is holding, A is the one who is holding, so A will get 6 months interest, 6 rupees. You paid 1, you got 6. What is the net benefit to you? 5 rupees. That net benefit of 5 rupees what you got is the interest what you earned from February to June. So that seems like a reasonable game, correct or not? Friends, let us now talk about the journal entry. How should we record this? At the time of purchasing investment, what is the entry we have passed? If we purchased it on 1st of February, investment in debentures account debited, say if the principal portion what we are paying is 100, you are writing it as 100, interest on debentures account debited 1 rupee, to cash or bank, say 101. That is the entry what you passed. Later, 6 rupees you are receiving as interest income. What is the entry for that? Cash or bank account debited to interest on debentures 6 rupees. Interest on debentures account on 30th June is getting credited with 6 rupees. But on 1st of February, it was debited with 1 rupee. So what is the net amount in that? 5 rupees. That will go into P&L account as income. So that is what will happen if it is debenture interest. Now imagine it is not interest portion, there was some dividend portion, but we did not know how much dividend we might receive. So what is that entry we passed earlier? We would have passed an entry like this. Investment in equity shares of say Tata Steel account debited with 102 to cash or bank 102. But for that period, we are receiving some dividend. When I say that period, you are getting dividend for the period for which you never held it. Something like the dividend, the investment what you made into equity shares was on 1st of February 2018. Dividend is paid by Tata Steel for period up to 31st of December 2017. For that period, dividend is paid by Tata Steel in the next period and we received that particular dividend. Now, what accounting standard says is, how much you received? 1 rupee dividend you received. Okay, fine. That 1 rupee dividend, you should not credit it to P&L account. Why? You are receiving an amount as benefit for a period when you are not the owner. If you are getting benefit for the period when you are the owner, you can say it is your income. It is not, but in this case, you purchased on 1st of February, but this dividend is up to 31st of December of last year. So, that amount of dividend is not earned by you. If it is not earned, it should not go into P&L. If it should not go into P&L, where should it go? The accounting standard says, at the time of purchasing, journal entry is very simple, investments in equity shares account debited 102 to cash or bank 102. When you receive such dividend, you should call it as pre-acquisition dividend. So journal entry, cash or bank account debited, say if the dividend what we are receiving is 1 rupee, cash or bank account debited 1 rupee to dividend income 1 rupee. But listen, this dividend income is not earned by us. This dividend income is something, it should be treated more like recovery of capital than return on investment. Something like out of 102, you recovered 1 rupee. Than you saying, I invested 102 and earned 1 rupee on that. No, it is not return on investment. It is basically recovery of investment. So, accounting entry for that should be, first, cash or bank account debited 1 rupee to dividend income 1 rupee. Next, dividend income account debited 1 rupee to investment in equity shares account debited 1 rupee. So basically what will happen, equity shares account will be, investment in equity shares account will be credited. Earlier it was debited with 102, now it is credited with 1 rupee. So after this adjustment, investment in equity shares will remain at 102.